At this point, I'd like to ask the panelists for the Institutional Capital panel to start making their way to the stage, as well as Jeff Riggs, who is the moderator of this panel. Jeff Riggs is the president of Essex Financial Group, and he's also the chair of our education committee for the Real Estate Center. Jeff is a big supporter of the Real Estate Center and the program, and has even hired many of our students as interns or for permanent placement. So I would like to personally thank Jeff for his involvement and his support of our program and our students.
Thank you, Katie. We have, as Katie said, I'm Jeff Riggs with Essex Financial Group. As they reset the stage, I'd like to make a quick change in the program. Frank Schmitz from Blackstone had a funeral suddenly come up, so we have subbed in very admirably with Greg Moran. So Greg, thank you for joining us. We'll introduce the panel here in a minute. First of all, again, I would like to thank everyone for coming today in support of the university. Earlier today, the previous speaker mentioned that 2014 was going to be like a James Bond movie. I'm thinking it's going to be a little bit more like a knife fight. The competition we're seeing today in institutional real estate is at an all-time high. I'd like to take this moment right now to thank on the front end our panelists, and rather than have me read through resumes, I've asked each of them to briefly talk for 1 minute about what their firm does and what they do at their firm. And I think this will give us a little background for our moments together. Colette?
Good morning. I'm Colette English-Dixon with Prudential Real Estate Investors. We're a global real estate investment management firm affiliated with Prudential Financial. I'm based in Chicago. We invest in all the basic food groups from office to multi-housing, retail, hotel, industrial, self-storage, you name it, we try to find a way to make it work. We are also very active, throughout the world in Latin America, Asia, and Europe. And my role is that I manage the U.S. investment dispositions platform out of Chicago. So thank you.
Good morning. I'm Rod Vogel with Principal Real Estate Investors. Principal's headquartered in Des Moines, Iowa, although I now live here in Denver. Principal, like Prudential, is institutional investment money manager in the business now over, I guess, 45 years as an organization. We invest across all the 4 major property types. It's almost exclusively institutional capital. And up and down the risk spectrum from core deals to development. My role with Principal is I run their U.S. Equity investment production operation. I'm glad to be here.
Good morning. I'm Greg Moran with Dividend Capital based here in Denver. We've been the sponsor of a series of domestic REITs that have totaled in aggregate roughly $10 billion. We've had a concentration in a number of those platforms in industrial, but we also have a diversified fund that invests in office, retail, and industrial. I oversee acquisitions for that platform in office and retail outside the West Coast.
And again, Greg, thank you so much for filling in for Frank. Really appreciate it. So in our short time together today, we're going to focus on 3 key topics. We have here on our panel some very distinguished and experienced people who are buying and selling income-producing real estate across the country, bring great perspective. So the 3 things we're going to try to talk about and focus on, make it interesting for you in the hour we have, is to talk globally or nationally about the trends and targets for institutional investors as represented by our 3 panelists today. Secondly, would like to specifically focus in on the challenges being a buyer and also being a seller today in this, this very competitive environment. And then thirdly, take the global experiences of this team and focus in on what they specifically think about Denver for 2014 and 15. We're very fortunate to have the depth and experience of these folks here with us, and I think they can bring a unique perspective to our time together. I would like to start off with a question about investment strategies and trends. And maybe I'll start with you, Rod. Could you talk about what your firm is seeing in terms of capital flows from your clients? I know that at Principal, you manage both general account, or what I would call your own money, as your principal insurance company, and then you also have a robust platform for managing third-party client capital. How is the inflow of capital at your shop today, and what do you see for the next couple of years?
Sure. Well, our platform is set up such that we manage global capital. So around the world, we're out there marketing our expertise. We invest all that capital in the U.S. And so, you know, as I look back over the past 12 to 24 months, what I've seen is, number one, a significant increase in demand from foreign investors. We've got a number of relationships with sovereign wealth funds throughout the world, and they have significantly increased their appetite for U.S. real estate. And I think many of you here have seen they've even started to come to Denver, and we'll talk about that a little bit later. But so a significant increase in foreign investors. If you look at historically kind of transaction volumes in the U.S., foreign investment's been maybe 6 to 10% of the overall transactions. Last year it was a little over 10%. And expectations it'll be 10 to 12% of the market. So they're becoming a larger influence in the marketplace. And then, as Jeff indicated, we run a variety of funds as well as separate account mandates. And in all cases, and this is mostly institutional, U.S. institutional capital in our funds or in our separate accounts, there's an increased desire for commercial real estate investments. And the reason I think is pretty simple. It's a relative value analysis as those investors look at alternative investments. Bonds obviously aren't yielding very attractive returns. Stock market offers attractive returns, but a lot of volatility. So all those investors, generally speaking, want 10 to 15% of their investable cash to go into real estate. And so that's been pretty consistent. It's actually moving up, from 8 to 10 to now to 10 to 15%. And so you get this confluence of significant weight of foreign capital, institutional capital, and Greg will talk about, kind of retail investors and high net worth investors also very active in the market. So last year we raised just under $2 billion of new capital. Our expectations it'll be probably around that same amount this year. So it's, as I'm sure you're all aware, it's a very liquid market, and I think 2014 is going to be even more competitive than what we experienced in 2013.
Colette, are you seeing the same kinds of flow for new capital into Prudential?
Well, I would never want to say that we're not doing as well as Principal. So I'm not, so anyway. I think in the U.S., high-quality investment managers are benefiting from the interest in the real estate markets here on all levels. And so the ability to raise capital from our institutional typical range of clients has been quite successful in the last 2 years, and expect that will continue. The ability to attract offshore capital into our accounts is kind of a new thing for us for investing in the U.S. as we converted our largest opened-end commingled fund, PRISA, to basically a private REIT that allowed it to attract offshore capital for the first time to invest in the U.S. and have found that to be an incredibly successful modification for us. And then, of course, you know, everybody who has the ability to reach outside of the U.S. and attract other capital and create those relationships is doing as much of that as they can. And I think that the ability to source sovereign wealth monies from a lot of places that maybe weren't typically on the radar screen has proven to be quite lucrative. And now it's all the problem of you got the money in the door, now you got to invest it, but that's another question. So we've been pretty successful. I think last year we ended the year for U.S. sourced capital or capital sourced to invest in the U.S. Different angle, same topic. It's been a little bit less than $2 billion, not dissimilar from Principal. Definitely not on the scale of the Blackstones of the world, but I try not to compete with them. That gives me a headache. And but yet we're finding that the ability to bring in the money and to successfully market for new funds has really been quite easy to do. Now we just have to figure out the right thing to do with it.
So with Principal and Prudential, what we're hearing as we start 2014 is capital's flowing into their accounts looking to invest in real estate. And Greg, you bring a different perspective because you're, as Rod said, you're using more of a public vehicle. Maybe you could explain to the audience the dividend model a little bit and
Sure.
various ways you're going at it.
Yeah, at Black Creek, we've raised money more similar to the way you guys have institutionally and with a couple of large sovereign wealth relationships. But for the domestic platforms, we've historically used the broker-dealer market to source retail capital for these platforms for non-traded public REITs. And ours raised money from 2006 to 2009, and then we launched another one in 2009 that just stopped raising capital last year, and the fund flows have been consistent and good. In the last year and a half, we have gone a new direction, which is restructured one of these funds to a daily NAV product with a radically lower fee structure that's really designed to access the registered investment advisor market. So we're really still in the early phases of that. We've started to get some traction, but we're really attempting to make a market where a market never really existed, which is always a challenge. So we're optimistic and getting some positive feedback and believe it's a much better product in terms of how it's structured for investors and priced daily within a more investor-friendly fee structure. So that's the direction we're heading with the new product.
So what we're hearing right now is capital's continuing to come into our space. And the interesting part of what we're hearing right now is that this is big money, big capital that is focused on core investments, value-add investments, all the way through the food groups, which we'll talk about in a little bit. But how this relates to Denver and our community is material. But as we talk, because it's competition, for acquisitions, they will be sellers. And I think that the most driving question today is how you're buying deals, how you're underwriting transactions, what you're seeing in the markets. And again, from the perspective of Prudential, the Black Creek family, or Principal, their yield metrics affect us even in the private capital side, which many in the audience make their living in a private capital environment. So I think it's very relevant for us to take a moment and talk about how you are seeing the competition today in basically how are you buying property, where are you looking, and then we'll attempt to draw that back into a Denver-specific. Greg, with your flow of funds, where are you most active today? What kind of property types and what regions of the country?
With the diversified fund, we're really focused in multi-tenant office and grocery-anchored retail, largely. Our colleagues with the other platforms are really focused in industrial. We've never been active in multifamily, but we're really trying to source more, I would describe it as sort of core plus office. That's probably 75 to 100% leased with maybe a bit of a leasing value add component rather than heavy reconstruction or new development. And I think, as I'm sure we'll touch on, I think we've really sort of moved out of the very crowded trade that exists in the coastal Big Six markets and started to focus more on some of the second-tier markets and maybe even building on some positions where we already have some concentrations within our portfolio. So having said all that, we've been a pretty heavy net seller in 2013 and year-to-date 2014, but we've also been very active on the buy side trying to buy stuff and getting very close. It's just the simple answer is you got to pay more. In the environment, it's very fiercely competitive from all angles, from domestic capital, private capital, public capital, foreign capital.
Total knife fight.
Exactly.
Total knife fight. So when you say second-tier markets, are you referring to markets like Houston, Dallas, Denver, as compared to the primary Sexy Six coastal markets, or are you going all the way into Middle America, Chicago?
Yeah, I mean,
Minneapolis?
I think it's a subjective answer. Everybody's got a different perspective on where you draw the line. Some folks that have bigger requirements to get money out, might draw the line after the Sexy Six. I would put Dallas and Houston and, I think Denver and even Austin almost pretty close to a first-tier market. My comment would, I think the trend is the same, is that capital gravitates towards those markets when they get priced out of the others, but the reality, I think, has become pretty quickly that there's not a lot of relief in those markets either. So, but we haven't really migrated much further than those types of markets, size-wise.
Colette, what is your 2014 corporate focus for locations, product? I know Pru is soup to nuts, all products, but specifically, are you targeting markets any more differently today?
The sharing of a microphone is interesting. We tend to look at the U.S. pretty similarly to probably most of our peer group. There is a little bit of a lemming effect that goes on in this business. Unfortunately, you can't go too far outside the box before people start accusing you of strategy creep. But we are very focused on multi-housing still. We are narrowing our list of markets because there are some places where the amount of product that's showing up this year and next year is making it a little scary. If you haven't already launched a deal, you probably won't now. At least we won't. There are going to be some opportunities in the secondary markets in the retail space, and maybe even tertiary markets in the retail space where we think that some of the shakeouts already happened with big box category killer Walmart Supercenter model. So we may look at those. The range has gotten a little soft on some product types because we think that you can actually do well in some of these secondary / almost tertiary markets in certain product types. So we're trying to be very open-minded about it. That being said, I don't see us investing much in Mississippi. So we're trying to be pretty consistent. In 2013, we were a net buyer. In 2012, we were about even. In 2014, we totally expect to be a net buyer. The opportunity to sell is very, very appealing because everybody's got capital, everybody wants to be able to sell something. It's probably a lot easier to sell in 2014 with the lack of product on the market than it may have been for the last couple of years. And we thought those couple of years were actually pretty good. But we're concerned about the balance of selling assets and getting money out the door. And it's a very interesting tightrope to walk. So we will be probably looking at $4+ billion of new investments for this year and about $2 billion in net dispositions this year, and it will be across the board. It's going to be industrial, it's going to be retail, a little bit of retail, not as much as before. It's going to be multi-housing, there's going to be some office that's sold. It'll be an interesting mix, and we're going to try to pick our buys as prudently so that we can be taking advantage of what may be dislocations in some markets, the ability for us to step in with our operating partners and maybe snatch a deal from someone else without going too far over the cliff on the underwriting, which is another discussion. And we also do a lot of business through partnerships. So about 65% of the new dollars we invested last year were in joint venture structures, because we do a lot of value add, core plus space. We don't execute, so we need an operating partner who really knows what they're doing to execute a strategy. So that will probably continue to be the main driver of how our dollars go out in 2014.
Rod, what are you and your crew thinking? Are you net buyers? Are you sellers? Are you both?
Well, we'll be, in 2014, a net buyer. And we'll probably end up, at least our projections are, somewhere around $3 billion of new acquisitions, and somewhere between plus or minus $1.5 billion of dispositions. You know, our whole, I guess, sales mantra with our clients is really a relative value approach to real estate investments. And how we do that is we're in 25, 26 markets around the country in the 4 major property types, and have expertise, you know, up the risk spectrum. So what we try to determine, and you know, it varies by client, of course, but you know, with us being in Memphis and Nashville and Austin and Raleigh, North Carolina, in addition to New York, San Francisco, Seattle, we try to, seeing what's happening in those markets, come back to our clients and say, you should buy retail in New York, you should develop office in San Francisco, you should sell industrial in Southern California, you know, whatever it might be. But given we're in the depth of those markets, it helps us kind of with a relative value story. Like Colette, some of our clients hear that, but they want to be in the top 6 or 8 markets, and that's it. And that's fine. That's, you know, that's acceptable. They just have to be prepared to pay for, the prices there. You know, I guess as we look at the opportunity set, what we've been gravitating to last year and will continue this year is probably 2 ways. One is move up the risk curve, which is for us, you know, buying vacant buildings or partially leased buildings or lease buildings with near-term rollover, but also quite a bit more development. We've been very involved in apartment development over the last couple of years. We won't likely do much more of that right now, given the tremendous amount of supply that's coming to the market, but we're very bullish on industrial and office development, and you know, right now have you know, over almost $2 billion worth of deals that are either committed to or underway in office and industrial development. And we just think there's a real attractive yield there relative to core investments. And so I think you'll see us operate you know, in that higher risk spectrum as well. We're still going to buy some core deals, you know, where we have holes in our clients' portfolios. And you know, we'll talk about pricing on that later, but it's we'll be up and down the risk spectrum, but more so value add and development in terms of new investments.
So we're hearing that the 2 of the biggest insurance companies are big-time net buyers this year. I think if you talk to the top 20 institutional real estate players, most would be buyers this year, which is, again, just going to create competition. Given that backdrop, Greg, as you look at getting capital placed, what are you seeing? Let's talk about specific metrics now. What are you seeing for cap rates in the markets that you're operating in for stabilized assets? Move a little away from the definition of core for a minute, but and try to focus on this from a stabilized lease property standpoint to an opportunity that's got some value add components to it. What are you seeing on the ground right now for your deals?
I think what we've been seeing certainly is tightening in pricing as we've looked at deals over the last year. You know, specific pricing, you know, we've been pretty active trying to buy a number of fairly stabilized office properties in some of the larger Texas markets, and I'd say those yields on high-quality stabilized product are you know, right around a 6 probably going in, maybe a little bit above it. And that's probably pretty consistent across a number of the sort of, I guess, second-tier markets for comparable quality and located product. And when we're really focused on the top-performing submarkets within maybe a dozen or so major overall markets. So there's maybe 25 submarkets that we focus in. But the coasts have been very pricey. You know, we bought a building the end of last year in San Francisco that was probably core plus and had lower yields going in, to be sure, that were much closer to 5 than 6. But stabilizing, hopefully, you know, in the sixes with some leasing.
So is your strategy to use leverage to enhance that early equity dividend rate?
We do use leverage, but we really use a combination of property level debt and corporate level debt, but we're probably a 50 to 55% leverage user, so not really taking full advantage of the low interest rates and the availability of debt as some are able to, and we've lost deals as a result of that pretty often. But we're not really pushing our leverage assumptions up to 65% or using short-term floating rate debt to prop up early yields. We're really looking at it on sort of a blended corporate cost of debt basis over a 10-year period. So it's made it a little easier, but not as easy as it has been for a lot of folks.
So Colette, we're hearing 5 cap in San Francisco, 6 cap on an office acquisition. What are the people in your loan committee talking about for going in unleveraged yields today? What are you seeing?
Well, I don't know that I want to sell an office building in San Francisco at a 5 cap. I think that number should be a 4. But
You made a good buy.
you made a great buy. Made a great buy. From the investment committee perspective, looking at opportunities right now, and we're trying to be cognizant of a combination of returns. So it's price per pound. It's our going in return matched against price per pound. If we're not stabilized, how long does it take us to get there? And what does that stabilized return look like? And then moving that forward, which of course on a core plus value add play is a shorter time frame than on a core deal. And how sensitive you're going to be to that residual cap rate. That's a huge mix of, just that whole stew of what that number turns out to look like is pretty varied. And I would say that in a San Francisco, if you're actually able to get a deal with a 5 in front of it, I think you're doing really, really well. Now, if it's a 5 at, $800 a foot, you might want to think about that. But if it's a 5 at $400 a foot, that actually sounds like an incredible opportunity, and your back end may look more like a 10 or maybe even a 9 on a good day. But that's San Francisco. If you took that same deal and you translated it to, I don't know, Minneapolis, that probably means you moved another 100 basis points up, up on the front end, and you probably want another 100 basis points or so on the back end. So we're trying to be open-minded and just look at the dynamics of the various markets and not trying to set something in stone. I think that becomes very, very dangerous. And we're not going to say, well, we're not going to do a deal below a 5, because that's probably not quite true. There will be some deals that are going to look really good that way, depending upon the dynamic of that market. If it's a San Francisco, if it's a Seattle, if it's, maybe it's the right deal in an Austin, depending upon where you are in Austin. In your New York, it never starts with a 5. I don't think it started with a 5 on a deal you want in the last, 10 years. I'm not really sure. So you've got to be really open to all of those dynamics, and our guys are having very intense conversations about that. Multi-housing looks very different too. And I think multi-housing for us is a value add core plus play. So it's definitely going in at what we think are going to be 5 plus 6 return on cost, maybe 7 if we're lucky, on a stabilized basis, and expecting to get out at somebody buying it from us at a 5 is my hope.
Yeah, I would agree generally that it's a combination of a lot of things, and more often than not, deals that we've just sort of tapped out at the last minute in recent history has been a function of price per square foot. It hasn't been a function of yield.
Yeah, the price per square foot thing has gotten to be kind of scary, especially when you're going, well, is it, what are you comparing it to? Is it replacement costs? Replacement costs moving all over the place right now. And, what replacement cost was a year ago, it's probably now maybe 10, 15% higher now, so it gives you a little bit more room. But sometimes you just kind of go, that just seems like a lot of money. So we're trying to be very, very flexible about that and look at all the different aspects of return in order to make the best decision on that asset at the time.
So 5 cap rates, 4 cap rates, 6 cap rates, all of these, I believe, are being underwritten based on unleveraged return metrics to start with. Some of us that are over 50 are kind of turning our heads a little bit going, oh my goodness, our capital is really cheap today. Rod, as you sit in your investment committees, what part of the going in cap rate discussion is your team focused on from a go, no-go decision basis versus the idea of stable rent growth, which I think is a big part of this discussion? And then I'd also like you to mix into that where that stable growth in rents, and we all live in the world of Argus now, where we can make anything happen based on our multiples. But in the real world of behind closed doors with your committee, how are you looking at rent growth, and where do you end up on overall return expectations today for some of the deals we're talking about here?
Sure. Well, if you think about the top 5 to 10 markets today, as we look at, and these are, say, fully leased, high-quality assets that anybody here would want to own, the unlevered IRR on a 10-year holding period is 6.25% to maybe 7%. And so I get asked a lot by our clients, hey, Rod, do you think real estate is mispriced today? And the short answer is no, we don't think it is. These cap rates are low, total returns are low, but a lot of that's due to the Federal Reserve and the very accommodative monetary policy. We're still sitting here today, I don't know exactly where it's at, but the 10-year Treasury is probably around 265, 270. Ukraine's had some impact on that, but let's just call it 265, 270. I mean, if you can buy an asset in San Francisco, I agree with Colette, it's sub 5, but those are below market rents. But anyway, if you get that, call it 6.5 total return over 10 years against a 2.6 Treasury, that spread is consistent with historical expectations. I think the risk, and what we talk a lot about in our committees, is the likelihood that interest rates are going to go up versus go down, on the next 10 years. And so how do you deal with that? And there's a couple ways we do. Number one, on those core deals, what we do is what we call a levered core strategy. If we're going to have to pay, a 4 cap and it's a 6.25 IRR in San Francisco, we're going to put 10-year debt on it that you can get today at interest only at 50%, probably in the low 4s. And so that'll give you, our investors, a little over an 8 total return over 10 years. And you've used that debt a little bit as a hedge. And I personally think that, over the next 5 years, that 10-year money you borrow today will become an asset versus a liability. So on those deals, we recommend our clients to lever it as much as you're comfortable with, which for these, it's usually 50, 55% where you get the best execution, 10 years, and just be comfortable with the 8.5% equity yield you're going to get. Now, the other thing we do with those, we want to be in markets, and I think San Francisco is one of these, where you can get comfortable with rent growth, and that if the economy or the 10-year Treasuries north of 3.5%, maybe close to 4%, that probably means the U.S. is generating significant job growth, over 250,000 jobs a month. So if that does happen, you want to have an asset that you can reprice the rents, because you've had rent growth, and so you can reprice it over that 10-year period of time. And so that's why we like multi-tenanted real estate versus single-tenanted real estate, where you've locked in the rates. In our committees, I think the metrics we look at, one of the most compelling is just reproduction cost. Having developed over the last 10 years almost $9 billion worth of real estate with our joint venture partners, and very active the last 2 years, we do know what reproduction costs are. Sometimes that hurts us, our acquisition guys, because we're building there and they're trying to buy above reproduction costs. So if we're at a point where the asset's trading above reproduction cost, there better be a real story to it, which probably means a strong tenant that's maybe paying above market rents. But reproduction cost is probably the #1 killer of deals for us right now. If we're above reproduction cost, we pass on it. The other metric we look at on a core deal, if you disaggregate the present value of that asset between cash flow over the next 10 years versus what's the net present value of your residual. I think today the market's probably saying 40 to 45% of that NPV is cash flow, 55 to 60% is, based upon that reversionary value. And that's getting a fairly high level of your value, based on a 10-year estimate of value in the future. So if we, see a deal that begins core and it's, 35% cash flow, 65% residual, we're probably not going to do that deal. It's another metric that we're likely not to break in terms of just managing the kind of, is the asset mispriced or not. We had a deal late last year in San Francisco. We were trying to buy an office building, one of the top 10 there. At the same time, there was an office building downtown San Jose, probably the best building in downtown San Jose. And, we were looking at both of them at the same time for the same client. And at the end of the day, on our numbers, the downtown San Francisco building traded at about a 6.1 unlevered IRR. It was about a 3.8 cap, which, again, below market rents. But 6.1 unlevered IRR, we could go to San Jose, buy the best building in that market with really no rollover for 5 or 6 years, and that was an 8.2 IRR and a 7.1 cap. And so our clients elected to pursue the San Jose and acquire the San Jose deal, saying 40 miles away, different markets, no doubt. They could pick up 200 basis points in return. They felt, and we agreed with it, that 200 basis point spread was adequate to compensate you for the risks of being in San Jose versus San Francisco. So, if it gets 100 basis points or less, primary, secondary, then we'll probably, revert back to primary. But if that spread's wider than 100, 125 basis points, I think the secondary market execution is from a risk-adjusted return perspective, is justified.
Greg, Rod made two interesting points there, that percentage of the total return that's cooked into the back-end reversion versus the cash flow, which is another way to protect against these low cap rates from an underwriting standpoint. What are you using in your shop today as you look at these new acquisitions? Do you have a rule of thumb or two of metrics that you're looking at in terms of percentage of cash flow versus reversion?
Yeah, I'd say all those metrics are very comparable. Of course, it's all a risk-adjusted analysis in the end, but I'd say those metrics are very similar in terms of, roughly half and half from income and appreciation, and unlevered IRRs that, we would like to stay as close to 7 as we can, but it's getting increasingly challenging to really have something with a reasonable set of assumptions that generates a 7 IRR for a good quality stabilized asset. So I'd say the metrics are pretty consistent. We haven't really dipped down into chasing assets that are sort of 6 IRRs. I think that's maybe a little bit below what our cost of capital is, but I know that's where the market is for sure.
Colette, how about in your shop? Are you using some of these same metrics as you look at it? It just seems stunning to me that at a 6 IRR, 6 to 7 IRR, you could cook so much, 40, 50% of that IRR in reversion. Seems like a challenging proposition, managing the risk. How are you folks looking at it?
It is really challenging, but again, I think in the institutional space, there are a lot of similar considerations on how we underwrite things. I mean, one client may choose to be a little bit more aggressive on one deal versus another, but we do kind of work within a fairly consistent, amongst the peer group kind of set of metrics. But the whole idea of how your appreciation matches up with your cash flow and how that blends to your total return is a large part of how many of us are judged also. You know, all of us who are technically investment managers and are subject to all of the indexes against which we are benchmarked with our peers, that combined return of cash flow and appraisal or, you know, valuation appreciation is a large consideration for how we look, especially some of the bigger deals that can start moving the needle on how we are going to be looked at from a performance perspective. So I think we're all pretty consistent on that one.
So let's talk for a few minutes. We talked about 3 and 4 cap rates in San Francisco and the flow of capital. I think with all of our panel here, they have pressures to be buyers today. Their capital, it sounds like, wants to be in improving rent market environments. The managed money is very focused on where it goes. Let's talk a little bit for a few minutes about how Denver fits into this. Rod, you made a great point there in the comparison between core San Francisco and San Jose and the differences in spreads. From your standpoint, Colette, where does Denver fit into this cap rate and overall yield metrics at a high level? I mean, it's product specific and cash flow specific, but I think our audience would be interested in taking the thought process of where you are at a national, global basis and relating it to the competitive environment here. Well,
I don't know that I feel very, very comfortable kind of setting up exactly, you know, if we're going to do an office deal in downtown Denver, it's going to have to start with 6. I'm not really sure that that's the case, because I think that's going to have something to do with kind of what's going on with the specifics of that asset. And, you know, is it above market rents or below market rents, and where do we think, you know, job growth is going? Denver is incredibly well positioned right now. I think that we've invested in this market since, I think, the early 80s, late 70s, and have had a presence in both office, and actually in office, multi-housing, industrial, hotel, and retail here at one time or another, and have continued to try to find the right space for us. And it's all come down to the specific deal. I mean, our guys who are covering Denver are competing for capital with the guys who are buying deals in California, or the guys who are doing deals in New York, and they're taking the best deal that they think they can get and the best opportunity and presenting it to the funds. And the funds are looking at all the markets and going, that seems like the best deal for us right now and how it fits in our strategy. So we have not done a lot of existing asset purchases in Denver. I think we've approached this market mostly from a development perspective, because we have found that if we buy in at cost for the most part, and our ability to take advantage of an improving market, which I think all the metrics are saying that Denver is continuing on an upward swing from office rent growth and multi-housing rent growth, at least for the foreseeable future, that there's a way for us to actually maybe make up for what may be a really kind of skinny return on cost with what we think is going to happen with rent growth and cash flow return. So I don't want to say, you know, we're only going to do an office deal at X. I think that might not be right. And I don't want to mislead anybody, because if you have a deal that we should see, I want to make sure I don't kind of, you know, kill the deal before you actually talk to me. But we do see Denver very positively right now, and recognize it's maybe a little bit of a timing thing for us, but think that all the factors are totally positive here, and would definitely, you know, look at ways to try to get in the market. That's probably the best I could say. Sorry about that, Jeff.
Sound like a bit of a dodge, but I think that what I'm hearing is Denver will not attract your capital at the same yield expectations as core San Francisco, which is reasonable. Greg, as you work your way through 2014, where is Denver on your on your strategy list?
It's on our radar. I sort of put Denver in a bucket that's similar to Austin at the moment, that it's a little too hot to touch for us at the moment. The fundamentals are all pretty compelling. There's population growth, there's job growth, there's infrastructure improvement, there's high quality of life, there's good things happening downtown, and it's attracting a lot of people, and the same thing's happening in Austin. But I think we've seen pricing exceed replacement cost on some pretty recent trades that have happened not too far from here.
Yes.
And pricing on some other assets that, we're just not able to get to the same conclusions on a risk-adjusted basis. So it's not a primary focus for us at the moment. For those reasons, I think there's a lot of new capital that sees it differently. There's a lot of new foreign money that's come into this market in the last 12 to 18 months, and it's been tough to compete with.
So I think there's a good snippet there to land on for a moment, and I'll ask Rod to kind of bring closure to this, but the dividend family is seeing it as a little hot right now, a little frothy, and yet Prudential has been a steady player here, and I think given the right price would continue, to put words in your mouth, Colette, continue to be interesting. Rod, you're officially supposed to office in Des Moines, I believe, but you live in Cherry Creek in Colorado. I think your testimony to what Greg just touched on, the quality of life, what we are selling here in Colorado isn't just a dividend, but we're selling an expectation that people will continue to choose to live here, businesses will continue to relocate here for many of the reasons Greg listed. For Principal particularly, you have been a very active player in our market, acquirer, seller, developer. What's 2014 and 15 look like from your standpoint?
Well, we're big fans of Denver. I think the secret is out on Denver relative to the national scene, and I think, again, the willingness of our foreign clients, and I'm talking primarily Asia, to look at deals in Denver has ramped up significantly from 12 months ago. You couldn't get them to even talk about Denver in 2010, 11, and 12, but 2013, they were interested. And one of the reasons they were interested in is, again, our very favorable view of the outlook for Denver. I mean, in the next 5 years, there's going to be another 250,000 people living here. There's going to be another 130,000 jobs created. So, that's obviously very positive for the real estate marketplace. I moved here for all the reasons, Greg talked about, the high quality of life. You got great, highly educated workforce. I fly a lot. The airport, I think, is great. And so, Denver offers a lot of attractiveness from an employer perspective, and that's the type of markets we want to invest in, where long-term you can be comfortable that, the risk return or the risk-adjusted returns are going to be reasonable. Denver certainly, from a